Hello and welcome to Cafe Mutual YouTube channel. Friends, the popularity of ETFs has been rising among section of retail investors, especially the millennial clients. In fact, individual investors now account for 3% of the total ETF AUM. To help us understand more about ETFs, today we have with us Arun Sundaresan, Head ETF Nippon India Mutual Fund. So with over 20 years of experience in financial services industry, Arun has played a key role in making passive investing popular among investors. So without wasting time, let's call him. Welcome to the show, Arun.
Thank you, Nishant.
So Arun, we all have heard about growing popularity of ETFs across the world. So can you explain to our audience what ETFs are and what is their relevance in Indian context?
Sure. So globally, ETFs and passive investing per se, both ETF and index put together, very popular. In fact, ETFs, somewhere around 2016, the global assets were roughly about $3.5 trillion. Today, it has exceeded 10.5 trillion US dollars. So that's like three times. And that absolute amount of money is humongous. Even in India, the space has picked up quite significantly, particularly in the recent past. Somewhere in 2016, there was hardly any assets. Roughly about 20,000 crores was what was there in ETF. Today, it is already more than 6.5 lakh crore. If you add index and ETF put together, that's about 8 lakh crore. So that's the size and the growth that we've seen both globally as well as in India.
Hmm.
Now, what is this ETF, exchange traded fund as they are known, is just like a stock or any security, right? So you want to buy a stock, you go and buy and sell that in the exchange. The concept is very similar. Instead of buying one stock, you buy a portfolio of stock as per the constituents of the index. And then you invest, you trade, you transact in them. So it's very simple. Depending on the type of the index, you just buy a basket of stocks, or in the case of debt ETFs, basket of debt securities, or in the case of commodity, a gold or a silver. So uh, otherwise, conceptually, it's just same as transacting in stock or any security.
Okay. So Arun, but what are the types of ETFs in terms of asset classes? You have mentioned about gold, silver, debt. So what are these?
So India, largely these ETFs are, in terms of asset class, you have
Hmm.
equity ETFs, fixed income debt ETFs, and
Hmm.
commodity ETFs. And under commodity right now, only gold and silver are allowed.
Hmm.
So within each of these asset class, for example, equity, there are various types of ETFs within equity itself. For example,
Hmm.
there are market cap based ETFs, like for example, Nifty 50 or a Nifty 100. That's like large cap. Likewise, there are mid cap ETFs, small cap ETFs, index funds, right? So these are all market cap based ETFs. Likewise, there are also sectoral or thematic ETFs. For example, if someone likes the idea of pharma, so you can straight away, instead of identifying which pharma stock to buy, sell, rather you can go and transact in a pharma ETF. Likewise, there is banking, infrastructure, and so on and so forth. So that's the second type. Then there are thematic ETFs. For example, may not be a particular sector per se, maybe a consumption as a theme, or we have the CPSE, Central Public Sector Enterprises, which in turn consist of power, oil and gas, and some sectors together. So that again is a theme. So you have those kind of ETFs as well. Then there are strategy ETFs. So, for example, factor based or various strategies. Suppose you want to play momentum as a factor, there are ETFs for that. You want to pick up those stocks which have done very well, they've created alpha. You want to combine that with lower volatility and create a ETF called alpha low volatility ETF. All those combinations are possible, making the space very innovative. So this is on the equity ETF side. Likewise, on the fixed income, various duration, and various strategies are available as well. See, for example, if you want to play around the long term 8 to 13-year GSEC, you can simply go and invest into a ETF, which will be governed as per the construction rules, and you'll be able to participate in the fixed income market through these ETFs. And then commodity, you have gold as well as silver. Silver has been a recent addition. So that's the various types of funds, and there are subtle variations within each categories.
Okay. So I have also heard about target maturity funds. So does this also qualify under ETFs, and how does it work?
Target maturity funds come under the index
Mm,
route, where you construct an index based on the maturity that you're targeting and the asset class. It can be GSEC or it can be SDL, state development loans, or AAA corporate bonds. You combine different asset classes and you choose particular maturity. So what they essentially do is they buy and hold a set of debt securities around that maturity till that maturity. See, for example, if you're getting into a 5-year target maturity fund now, so most of the securities will be maturing around 5 years. So in a way, it is like hold till maturity. And when you're investing, suppose the yield of those securities, let's say, is around 7.5, unless there is going to be any default, which is unlikely because these are all GSEG, SDL, and maybe AAA corporate bonds, right? If you hold till maturity and you don't do anything about it, you're more or less likely to get a return
mm,
around the yield which is prevailing now.
mm,
So, which makes it that you have a reasonably good visibility of return, right? When you're getting into it, it also comes with additional liquidity that even though this is a 5-year target maturity fund, you need not necessarily hold till 5 years. In case you want, for some reason, to move out after the second year, 2.5 years, you can also do that at the prevailing NAV. So it combines the visibility of return along with the optionality or the liquidity to move out at any point in time.
So Arun, I have observed that investors cannot buy ETF through regular plan route. So why is that so?
So just like how in stocks, you do not have direct, regular, there's just one price,
Mm,
right?
mm,
So likewise, the ETFs have one price
mm,
on which they are traded on the exchange, right? So you technically cannot have various options within that. So that's the reason why you're not having that. So for all practical purposes, this is more like a stock rather
mm.
than a normal mutual fund, an open-ended mutual fund where you will have various options. So that's the key difference.
Okay. So Arun, how can an investor buy ETFs, and what are the prerequisites to invest in them?
Sure. So just like how you require demat account, in the case of transacting in securities,
Mm,
in capital market securities, be it in bonds or stocks.
mm,
Similarly, for transacting in ETFs, you need to have a demat account.
mm,
And once you've established your demat account through your stockbroker, then you're free to
mm.
invest, transact on a regular basis, using that particular demat account. So it is as good as trading in any other security.
Mm. Okay. And you need a demat account for that. And what are the charges associated with investing in ETFs?
So generally, ETF will have a expense associated with it. Ultimately, there is a fund house, a fund manager who's managing in terms of replicating the index. So there are incidental costs associated with all of that. So all of that will get covered under the expense of that particular ETF. That's number one.
Mm,
The second thing is when you trade, when you transact in that particular ETF,
mm,
there will be a bid ask spread. See, for example, if the NAV of that particular ETF is 100,
mm,
and during the day it's reflecting as 100 rupees in
mm,
the stock exchange, you may not necessarily be able to sell it at 100. That will depend on the liquidity on the exchange. When you are selling, there
mm,
should be counterparties.
mm,
Depending on the quantum of selling that you do, there has to be good amount of volumes to support.
mm,
Somebody has to buy that. So depending on that demand and supply, there can be some impact cost.
mm.
So that can also be a cost apart from the expense ratio. If the bid ask spread is more, the impact cost will be high, and that will also have a bearing on your return. So these are the main expenses. Of course, there is this STT and other small charges which are very very similar to applicable to stocks.
Okay. And ideally, how much allocation should be given to ETFs?
So, so basically, I've known investors who invest completely into ETFs or passives. Their 100% of the money also
Mm,
can be in because see, ETFs or passive investing is just one way of investing, right? Except for the fact that there is no active stock picking, how much to buy,
mm,
what, when. Except that part, otherwise it is as good or as risky as investing into capital markets. Like
mm,
depending on the type of ETFs you select, equity or broader market sector. So you do get into that risk and return. The only different factor there is no active stock picking. As a result, the cost also tends to be relatively low. Otherwise, potentially I can build my entire portfolio using passives also, right? So a
mm,
lot of people, what they do is they build their core portfolio using the broad market-based strategies. For
mm,
example, depending on their comfort and their risk return appetite, how much of large cap, mid cap, small cap exposures they need to have, they can use that bit for their core of the portfolio. And over and above that, if they like a particular sector, for example, I like banking, I want to know more of that, or I like power
mm,
infrastructure, then I find some strategies, ETF, and add a little more of that.
mm,
So that's very much doable. So on the other hand, there are investors who invest only into actives as well. So they take a similar approach in active. They invest a good amount in large cap, some portion into small cap funds, and then they get into sectoral schemes. So it is a philosophy. It is a preference. And but then given that there are equity ETFs, fixed income, commodity,
mm.
and there are a lot of variations, as I mentioned earlier in the conversation. You can mix and match, and you can build your portfolio entirely through passives through these ETFs.
Okay. So, Arun, there has been concern around liquidity part of ETF. So, can you throw some light on this aspect of ETFs?
This is a very critical aspect of investing into ETF, Nishant. The earlier question you asked was about the expense.
Mm,
There could quite possibly be a ETF, for example, where the expense ratio could be low.
mm,
But if that ETF, for some reason, if the liquidity is not there, which
mm,
means that it's not getting traded enough, right? So that will lead to higher bid-ask spread and higher impact cost.
mm,
And that number can be very high. In fact, we have noticed in some of the ETFs where volume liquidity is not there, the impact cost could be as high as 1% or even 2%,
mm,
right? So that takes away the entire essence or advantage of investing into passives, which
mm,
is essentially about efficient way of investing into the capital markets at a lower cost. So therefore,
mm,
this liquidity and consequently related areas like impact cost will
mm,
have to be paid particular attention to.
mm,
But having said that, the good part is that the data pertaining to volume, impact cost about any ETF is in the public domain. So all investors and our partners need to do if they are analyzing, let's say,
mm,
2 or 3 Nifty ETFs, right? And they are deciding which one to buy. All they have to do is go to NSE site or BSE site, just like how you type out a stock name and search. You type out the ETF, for example, Nifty Bees, that's our ETF, you will get all details. What is the today's volume? What is the last 1 year average? What is the impact cost? And then you compare some other ETF, you will see the difference. What is impact cost? That needs to be a important consideration. It has a direct bearing on your net returns.
Okay.
So, along with expense ratio, you should also consider these aspects: the volume and consequently the impact cost.
Okay. So, Arun, is impact cost and average 1 year average trading volume has any relationship with the AUM or size of the fund?
Not really. There are cases where the fund is large. It may be due to a few institutional investors.
Hmm.
Therefore, the volumes may not happen. So,
Hmm.
larger the size does not necessarily mean that correspondingly the volume will be high.
Hmm.
So, the volumes will have to be more organic. That should be more number of
Hmm.
investors, retail or individual, other types of investors. It should not be concentrated. Therefore, I wouldn't say that the size is directly correlated to volumes. Having mentioned that, volume, on the other hand, is directly proportionate or it directly leads to lower impact cost. If
Hmm.
the volume is higher, which means that there is active trading,
Hmm.
if you're going out to sell, there is someone out there to buy, and vice versa, that naturally leads to lower impact cost. So, more than the size of the ETF, so the traditional wisdom could be, and you could be assuming that the larger the size, it's very popular, and volume will naturally be high. That may not be the case. So you need to necessarily look at what are the average volumes over a period of time, and what is the actual impact cost. And that number is actually calculated by the exchanges. So they have and which is the same methodology used to calculate impact cost for even stocks,
Hmm.
right? So everybody understands the concept of illiquid stocks, right? So the stock may be giving excellent return, but if you're not able to sell it, or if the impact cost is very high, then ultimately your return will be suboptimal. So that is a concept is very much applicable to ETFs. So that needs to be kept in mind.
So, Arun, one last question. So, when all ETFs tracking a particular index like Nifty 50 have the exact same portfolio, right? So, how can investors shortlist, ETFs for investment?
Yes, Nishant. So, just to simplify things, sometime back at Nippon, we had come out with this campaign. In fact, we had we had put together an acronym
Hmm.
which investors can easily remember,
Hmm.
and that can be used as an yardstick to assess or rather, decide between different ETFs. So that is called as VICTER, VICTER.
Hmm.
So what it means is, and what it stands for is, V stands for volume. We just spoke about it. So between two ETF, the one with the higher volume, amongst other things, is better. Number one. So that is V. IC is impact cost. So which we just spoke about.
Hmm.
And there is a direct or rather an inverse relationship, so to say. Higher the volume, lower will be the impact cost. So you look at both volume and look at the actual impact cost number. And you notice that one ETF is, let's say the impact cost is 0.02. There is
Hmm.
another ETF with impact cost of zero point 0.5. There is
Hmm.
a big difference. So essentially, you will end up paying 0.5%, or you will give up 0.5% of your return if the impact cost is as high as zero point 0.5 instead of 0.02. Right?
Hmm.
So that is IC, VIC. T is the tracking error. Tracking error, again, is a number which is generally taken by the closing prices. It figures out how well the particular fund is replicating the index. So
Hmm.
tracking error again should be on the lower side.
Hmm.
But generally, tracking error for most of the ETFs will be similar,
Hmm.
because it is end of the day, it does not reflect what happens during the day when investors track. But having said that, that is also something that needs to be kept in mind. That's the T. and ER stands for expense ratio. So again, amongst all other things, lower the expense ratio, the better. But you should keep in mind that should not be the only determinant. There are two ETFs, and then you select the one with the lowest expense ratio, but that ETF is not efficient, volume is low, impact cost is high. Your net, your investment experience, your actual cost will be much higher. So you will have to look at all these things together. VICTER, VICTER. That would be a good way to go about looking at ETFs.
Okay. So, all right, we have come to an end to this interesting discussion. Thank you so much, Arun, for your valuable time and inputs.
Thank you, Nishant. Hope the users find this useful. Thank you very much.
Great. And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.